Asia Pacific is seeing rapid growth in parametric insurance, with premiums rising over 19% year on year. Fast payouts make it attractive, but fixed triggers raise serious questions as climate risks intensify. Here to share more details are Andre Martin from Swiss Re and Ruth Lux from the Insurance Development Forum. Now let's begin with a bit of a background. What are the main limitations of trigger-based parametric insurance?
Parametric insurance fundamentally requires two things. We need objective, reliable data post-event, which allows us then to assess whether or not the policy has been triggered. But we also need historical data series. And this is for the purpose of modeling, calibration, and pricing accuracy. Usually, this data availability is less of a concern or problem for the more popular, prominent NatCat perils like typhoon and earthquake. But when we look at more specific, in particular non-weather perils, and also in more emerging markets, sometimes this data is scarce, it is unstructured, and sometimes not even available. I would also say that parametric insurance certainly has moved very firmly from exotic into the mainstream. But still, there seems to be a lack of, or an educational or awareness gap. But I think that most risk managers in the corporate world most certainly have heard about parametric insurance. There seems still to be some degree of hesitance when it comes to actually implementing it. And this is really why we think that this continuous education, awareness creation is crucial if you really want to further progress the adoption rate of these parametric solutions.
Parametric insurance is not a silver bullet. It can't cover every risk and has inherent limitations. One of the biggest challenges is what we call basis risk. That's when payouts don't perfectly align with actual losses. Another issue is the reliance on specific triggers like rainfall levels, wind speed, or seismic data. That means sometimes damage can occur, but the trigger isn't met, so there's no payout. Its effectiveness really depends on strong product design, reliable data, and clear governance. And in practice, it works best when it's part of a broader risk financing strategy, combined with reserve funds, contingent credit, and traditional insurance, so that payouts line up with real needs.
So given this, how can insurers address the coverage gaps in parametric policies?
It really comes down to the right structure. Now, as mentioned before, the advances in technology, in data analytics, certainly have helped us to come up with more specific triggers, and really also using triggers that are much closer correlated with the actual financial loss. And this is what we broadly then term as the second generation of parametric insurance, where we use these intensity triggers, like, for example, the shaking intensity in an earthquake at the surface, at the specific location of the insured, or in case of a typhoon, the wind speed at the specific location of the insured asset. Another way of reducing this basis risk is or are multi-trigger solutions. And here, a very popular combination in recent times is combining, for typhoon, for example, wind speed and central pressure. Central pressure has actually proven to be a very good proxy for rainfall and resulting floods. And by combining these two triggers into one single solution, this insurance would then capture not also like the less intense storms, which have probably less wind speed damage, but can cause a lot of rainfall, a lot of flooding in the area. And then the third point that I want to mention here is that we're seeing an increased interest also in locally installed sensors at the specific location of the asset, rather than using these measurements of publicly available weather stations, which might be tens or even 100 kilometers away from the location. And this is in particular important for very localized perils, like, for example, flood or hailstorms.
Well, great question. And insurers can focus on product design improvements to reduce basis risk and align payouts more closely with real impacts. Another key step is to use layered strategies, combining parametric products with tools like reserve funds, contingent credit, and indemnity cover. For large-scale use, especially with vulnerable communities, it's essential to have sovereign involvement and reserve funds in place so solutions are both accessible and also sustainable. Public-private partnerships are also critical, with governments, development actors, and insurers co-designing solutions together. Transparency matters too. Clear monitoring of payouts and tracking benefits at the community level builds trust. And finally, the more we implement and test these solutions, the more evidence we build to refine and to improve future models.
You mentioned a lot of good points earlier, but at the same time, there will still be constraints. So what exactly makes parametric insurance still appealing?
The most important implication that we see is really the protection against these pure financial, pure economic losses that are not triggered by a physical damage. And here we're looking at these supply chain disruptions, or more generally, non-damage business interruption. And this non-damage business interruption exposure is becoming increasingly important in a corporate world that is shifting very clearly from asset heavy to asset light, meaning that corporations derive more and more of their revenue from intangible assets rather than from physical assets like equipment and machinery. Then we have the argument of the liquidity. Now, because a parametric insurance or the payout of a parametric insurance solely relies on this measurement or follows a very straight formula, the payout is extremely transparent and very quick. So we see them very often being used also in circumstances where this quick access to liquidity is crucial. I'm thinking here about government entities who need this quick injection of cash immediately after disaster strike to provide these emergency relief activities.
Well, parametric insurance works best as part of a broader resilience strategy anchored in strong public-private partnerships, which I've alluded to. When designed effectively, parametric solutions provide speed, transparency, and certainty of payout, all of which are critical in the aftermath of disasters. This rapid liquidity can make the difference between a swift recovery and a prolonged crisis. When designed well, parametric insurance offers speed, transparency, and certainty of payout, and that's absolutely critical after a disaster. Having liquidity within days rather than waiting months for claims processors, as in the case of indemnity insurance, can be the difference between a quick recovery and a prolonged crisis. We've already seen real results in regions like the Caribbean, Africa, and the Pacific, where parametric solutions have strengthened resilience. Parametric insurance also works as a credible entry point for governments and donors to structure broader disaster risk financing strategies. So while parametric insurance isn't a standalone solution, it is a vital component of a comprehensive resilience framework.
Thank you so much for joining us today and for sharing your insights, Andre and Ruth.
Thank you.
Thanks for having me.
Once again, those were Andre Martin, Head of Art Structuring for Asia and Australia and New Zealand at Swiss Re Corporate Solutions, and Ruth Lux, Private Sector Co-Chair of the Sovereign and Humanitarian Solutions Working Group at Insurance Development Forum. For more news, visit insuranceasia.com.